Matthew Peterson is the managing partner of Peterson Capital Management, which he founded in 2011, so quite a long time ago now. As we know, he manages a long-term concentrated value-based fund with a very impressive 12-year annual track record that's drifting into Buffett territory, exceeding 15% annualized. Matthew's been a financial professional for almost 25 years. He is a chartered financial analyst and has worked for Goldman Sachs, Morgan Stanley, Merrill Lynch, American Express, Ameriprise Financial, and most notably, he's even featured on the New Money YouTube channel. So without further ado, Matthew, I'll hand it over to you.
Brandon, thank you so much for the warm welcome, and thank you for being here. We're so pleased to have you here to host this year's Peterson Capital Management annual meeting. As many of you know, Brandon's YouTube channel, New Money, is becoming quite successful, has high quality content, and it's growing rapidly. The subscribers now are approaching 1 million, and very few people can achieve that. He's joining us here from Australia, where it's very early on Sunday morning. So Brandon, we do deeply appreciate you making the time.
Thank you.
I encourage you all to go and look up his New Money channel. It's a wonderful place to start your investment experience. But most importantly, I want to welcome all of you here to the Peterson Capital Management annual meeting. We have people joining from all over the world. We have hundreds of RSVPs representing 15 countries. We have over 25 states. We're so pleased to have everybody here today. This fund, as Brandon mentioned, was established 12 years ago this October, and it's been a remarkable journey. It's been marked by growth and partnership and even innovation. It's an honor to have so many esteemed partners part of the firm. We have many longstanding partners here today, as well as many new partners who are joining every single quarter. I very much look forward to sharing these details with you today and having the Q&A so we can get to what's on your mind. So today we have a few exciting updates and some interesting items to discuss. So we'll begin here with the prepared remarks. We'll discuss the fund performance. We'll provide an update on several wealth building compounders in the portfolio, and then we'll reveal some details on the Python software that we built to execute our structured dividend capture position. This is our proprietary solution for cash management. It allows us to quickly reach in and grab dividends out of the market, which through our backtesting has proven it yields double-digit annualized returns. So following my initial remarks, there is a little surprise. Our team has built a nice little treat for you using some cutting-edge AI tools, experimenting with the capability. And then, as mentioned, we will move into the Q&A at the top of the hour. So with many first-time attendees here today, we're going to begin with the mission statement. Our mission is to provide a world-class capital allocation vehicle that builds enormous wealth for our long-term partners. And today, we're receiving a lot of new attention regarding our research and our performance. We're making robust progress toward achieving this ambitious and challenging mission. Our NAV, our net asset value, have been climbing for many years, and although we remain very small and we are a nimble fund, we began this fund in 2011 with less than $1 million under management, and we have grown these assets now to over $20 million. This is a result of our compounding, of existing partners continuing to add to their position in the fund, as well as new partners joining the fund. And this is a fantastic time to be involved. So if anybody's interested in participating further, October 1st is our final commitment date for 2023. Please reach out to us if you're planning to add to your account or if you're a new LP who's interested in joining the fund so that we can prepare for your capital. You can send a note to me or to andrew.park@petersonfunds.com so we can assist you with this process. But we're going to go through this very quickly right now. Remember, we have no control over the stock price at any given moment. Nobody does. So we can't control the outcome at a point in time. What we can control is our process. Our process here has 4 key alpha producing steps. We begin with a 13F analysis, and this is strategic. We're tracking the holdings of nearly 100 top quality long-term value investors, and there's a lot of wisdom in seeing where the money is flowing. These 13F filter out about 95% of the market. So historically, this quarterly analysis was really time intensive and it was a daunting exercise. But today we've written Python scripts and we've automated it all. It turns our multi-day ordeal into an efficient, streamlined process where we sift through thousands of companies and opportunities, and it provides us with a superset of just several hundred that we can look through that are already in the portfolio of legendary value investment teams. And this approach is far superior to the standard screening for cheap companies. Many funds and individuals look for companies based on a screen of ratios or a variety of metrics, but screens of this type create two specific errors. They suggest false positives and they reject false negatives. So our approach allows us for a deeper qualitative assessment of the firms where we might be able to identify attractive features that are missing from the financial statements. The things that are missing from a financial statement may also be missed in a screen. Specifically, if we use our 13F analysis, we dodge more mistakes and we catch more opportunities. Following our 13F analysis, we dive deep into the fundamentals. This is about reviewing the financial statements, but it's also about understanding what the financial statements are missing. We're looking for extraordinary firms that satisfy this co-priority framework. We need exceptional business models, extraordinary management teams, and a great price. And these situations are extremely rare. When we get to step 3, we integrate our structured value process into the equation. This is where we apply our structured value purchasing method and we determine the optimal way to obtain our ownership. Often this is done by writing put contracts to use as a tool to buy our shares for below market prices. And it's an extreme advantage. Surprisingly, it remains a rare secret today. We get way better prices than a retail investor. And outside of the people on this call, there are only a few people on the planet who are putting this into practice correctly on a regular basis. And it is a major advantage for us. This space is very uncrowded. We benefit from the volatility. We benefit from the mispricing. And it directly correlates to higher returns in our performance. And finally, we move into step 4. So after a company passes our rigorous standards, we need to consider how it fits into our portfolio. And we do this through our portfolio construction philosophy. This includes quantitative assessments like opportunity costs and Kelly criterion, where we're optimizing how we size the positions and allocate capital. We run a concentrated portfolio because when we bet, we do deep research and we bet with large conviction. So for us, it's about optimizing our diversification. And this is the process that has led to the construction of our infinite compounder portfolio. The undervalued group of holdings that we now own have the world's best business models, world's best management teams, and will continue their growth for decades. And here you can see the portfolio today, our list of these infinite compounders. And these aren't merely holdings, these are truly partnerships with the prospective firms. Our stock ownership means that we own 1% of the firm. We own their assets, we own their liabilities, we own their equity. And we are fractional owners of these businesses, and we have no intention to sell. These are our asymmetric bets. They're bets with convexity. We have limited downside due to the inherent strength and the compelling valuations, and there's earning growth. Combining this with the tremendous upside potential that's unfolding creates this asymmetry in our portfolio. And there's a nice golden thread that weaves all of these hidden treasures together. They contain substantial off financial statement value, from latent revenues that are coming from Daily Journal to the intricate web of assets within Berkshire Hathaway. The value of these assets don't appear on the financial statements. They don't show up on the balance sheet, But in time, the hidden treasures manifest in forms of future earnings. And then the stock price grows to reflect the new reality. Some of you will notice that one of our compounders is absent, Seritage Growth Properties. Later, we will discuss how we secured a very nice profit. Our intention is to own these businesses for an infinite time horizon. However, we are not passive spectators at all. We monitor these holdings with the utmost diligence. We are disappointed to see that Seritage is in fact shrinking. The upside has become muted. The risk return has inverted. And given the opportunity cost of the position, the rational decision was to exit. And we did secure over 100% gain in just a few years. We will share some internal analysis on Seritage in just a moment. But first, let's jump into Berkshire Hathaway. Simply put, Berkshire is thriving. It has a rock solid business model, top tier management teams, and Berkshire is able to gain market share through difficult macroeconomic periods. So it stands as a beacon of corporate excellence in America. So in 2019, I shared a simplified three-factor model to estimate the current value: cash plus the market price of the current equity portfolio plus the wholly owned subsidiaries with a multiple on their earnings. And at the time, Berkshire was selling for just 400 billion or so. We were confidently forecasting in 2030 a market cap of 1.7 trillion for Berkshire, and some very astute individuals challenged the projection. They were questioning how such a large company could grow that much further at such a rate. Yet here we stand. We're in 2023, and our 2030 figures presented here are unchanged. Today, I am confident that Berkshire is not only on track to meet our projection, but it's poised to potentially exceed the estimates as we approach 2030. And given that Berkshire is buying back its stock, the share count is going down, and on an individual share basis, our shares can appreciate more than the company as a whole. So let's break down Berkshire into its three components quickly: the cash, the market value of the securities without the post-tax, and look at the growing earnings from its extensive roster of wholly owned subsidiaries, ranging from these iconic brands like See's Candy and infrastructure plays like Mid-America Energy and Burlington Northern Railroad. As of last week, the column here titled Value Today, right in the middle, the numbers shown are really compelling. We're looking at 142 billion in cash, 260 billion in an equity portfolio, excluding the tax liability, and the value from their operating businesses are now estimated at $720 billion. So that sums to a value of over 1.1 trillion today. And to put this in perspective, based on the stock's price, this suggests a substantial upside today, 40% on Berkshire Hathaway. And very importantly, the value is not static, it's growing. So this is a key driver behind Buffett's decision to be buying back billions and billions in Berkshire stock. So we are extremely confident and pleased with Berkshire's future prospects, but of course, that is not all. This fund is not in the business of paying New York Stock Exchange prices for our shares. We're not retail investors, and I don't consider anyone on this call retail investors either. We deploy our structured value method to purchase stock. So in Berkshire's case, we're simply selling puts when the yields become attractive. And we've been systematically accumulating shares in Berkshire during price dips by writing these puts since the inception of the fund. This strategy pays us a premium upfront for our commitment to buy Berkshire shares if they decline, and it aligns our purchase with highly favorable entry points. So this is a quick example of how it works. Consider an example with an opportunity to buy an outstanding business, a very inexpensive business, selling for $100 on the New York Stock Exchange. Most retail investors find it convenient to buy shares in a brokerage account for $100 with a market or a limit order. but there is a much better way. It's a two-step procedure. It's much more complicated, a two-step procedure. Instead of paying $100 today, we simply sell a put contract through the Chicago Board of Exchange that commits us to paying $100 12 months from now. And we are paid for that commitment. In this case, we're paid $25. And 12 months from now, the contract expires and we have a binomial outcome. If the price of the shares falls below 100, we purchase the shares for a net cost of 100 minus the $25 received in premium, or $75. If the market price is above 100, the contract expires and we do not buy the stock, but we keep the $25 in premium that we are paid on our $75 in collateral, earning an annualized return of 33% without even owning the stock. So if we purchase shares using structured value versus limit order on the New York Stock Exchange, we pay 75 instead of 100 for the same shares. And what that means is when the shares appreciate to say $750, we have made a 10x return while everyone else just returned 7.5x. And that's the difference of turning 1 million into 10 million versus 1 million to 7.5 million. It's a very big advantage. And for further clarification, because we'll be coming back to these examples, there are 4 major outcomes that can occur. In situation 1, scenario 1, the analysis here has been done wrong. The stock goes to 0. It's a bad and it's an unlikely outcome. It's a bad outcome. This is where the shares go down significantly and we're committing to buying them. However, if we use the prices from the previous slide, instead of buying for 100 and losing 100, using structured value, we buy for 75 and we would lose much less than a typical retail owner. Scenario 2 is the best outcome. This is where the price declines slightly to say $75 a share, and the shares are put to us for our net cost of 25. Here we own the shares for a true discount to the market price, and this is a very common occurrence. Scenario 3 is also very attractive, where shares rise slightly to say $105 a share. In this situation, we don't buy the stock, but we do earn the $25 in premium on our $75 in collateral, a 33% annual return. It's a very satisfactory return. And finally, in scenario 4, this is a less attractive scenario where shares rise significantly over 12 months, let's say to $150 a share. In this situation, we will still earn the attractive 33% yield, but we do miss out on the 50% gain in the shares because we did not own the stock yet. But of course, Berkshire is among the highest quality businesses in the world. It has a growing intrinsic value. There are short-term price fluctuations within Berkshire. In fact, we've seen many times where Berkshire stock moves by 50% or more. But there's virtually no chance of Berkshire going to 0. In situations like this, scenario 1 is off the table. So we're left with 3 relatively attractive outcomes. So let's take a look at how this impacts another one of our portfolio holdings, Alibaba. Alibaba is one of the greatest business growth stories that the world has ever seen. They have a conglomerate of businesses with great, outstanding business models. They have extremely capable management teams, and they have an extraordinarily low price. Baba is most known as the largest e-commerce and cloud service provider in China, and they operate a bunch of platforms like Tmall and Taobao. But despite some of the clashes you may have seen between Jack Ma and the CCP, Alibaba is moving into a new stage of their business. Daniel Zhang, the CEO, has delivered growth in e-commerce, and he's expanded the business internationally. And the intention now is for Alibaba to continue their expansion into the 22nd century, 75 years from now. And they are currently pursuing an organizational transformation where 6 major business groups have been formed to be independent and to decentralize their operations. And some businesses like cloud is going to be spinning out to the shareholders altogether. So we have evaluated each of these business groups, and we found the following. When we break down the business groups, it becomes clear that these shares are very mispriced and they have extremely large upside potential. So in the dark blue, you can see estimates for each of the future divisions today. Okay, you can see that there's the China's e-commerce business, which is the core Baba holdings. You can see digital commerce. You can see cloud with 17 billion, digital media, their smart logistics group, and local consumer services. Each of these will have value, and they will act as a catalyst as these transformations occur. Now, this slide is still a work in progress. We expect these numbers to be more clear, and we will continue revising these and increasing their accuracy. But today, Baba's pursuing this 1 + 6 + N structure. And they're with their investment portfolio, where they have almost 30 billion in a portfolio and they have almost 50 billion in cash. It's quite impressive to see that the value here today is at least 310 billion and growing, almost 50% higher than the current market price of 220 billion. And as these corporate events unfold over the next 24 months, they will each be acting as these catalysts, helping the market to realize Alibaba's true value. But of course, that is not all. We don't buy these shares like a typical retail investor. We're using our structured value to buy these assets for below market prices. Today, the shares sell for just under 90, with a total market cap about 220 billion. And we can write puts, committing ourselves to buying for 90 in December 2025, just over 2 years from now, in exchange for being paid a $20 premium today. In just over 2 years, this demonstrates that on one hand, you can receive a 30% gain from the premium, earning $20 on 70 in collateral. And you have that potential to accumulate Baba for just $70 a share. So this puts the cost of Baba, this brings the cost of owning Alibaba down to just 175 billion, while they hold 50 billion in cash and they have a $25 billion investment portfolio. So if you consider that the e-commerce business is earning 25 billion in EBIT, and we've structured a way now to purchase these operations for just 100 billion of net of cash in their investments, those here who understand these metrics are going to recognize immediately how remarkable it is to find just such a robust and growing global conglomerate available at these prices. Further, I will add that they are spinning out many of these entities. We will receive additional shares and we will monitor those holdings closely. So should we determine a lack of future potential with some of the spinouts, we can exit those spinouts for cash, further reducing our cost of ownership of Baba. So it's quite an exciting place to be. We need to keep moving along. So let's take a look at the exited position, Seritage Growth Properties. Seritage is the real estate spinoff of the ex-Sears stores. It's engaged now in a strategic alternative to growing the firm. They are selling each of the remaining assets, their property and mall assets, and after paying down their debt, they're going to be issuing special dividends to the shareholders. We essentially exited this position earlier this year, and we removed it from our infinite compounder list because the risk reward has inverted. We've been analyzing the 212 malls that were owned by Seritage for years, and they are now down to the final 45 properties. And this week, actually, we met with John Gorelli, CFO, independently, who helped confirm some of our data that we're sharing with you today. So this is very, very up-to-date data. And if you want to understand how we're accurately projecting these prices, it's sort of the theme remains throughout. It's simple, but it's not easy. We just have to value every single mall. So it turns out after doing this exercise, we can't find anyone else who did the analysis we've done. Seritage has 5 property types. And in each of the property types, we've provided the values here for you to consider or comment on if you have thoughts. This is the healthy way to engage in the discussion. We should be evaluating the individual property values to determine if Seritage is underpriced, overpriced, or appropriate price. And on social media, there's a lot of people discussing our opinions. Most are in agreement. Some are in horror as these values decline. But, we should be having a constructive conversation about the property values themselves. So let's look at what we're providing here. We have premier properties. These are the true valuable assets that are held by Seritage. And although internally we look at these as factors and we determine a range, we've selected the base case for a lot of these sales. Aventura, 215 million, Dallas, 50 million, Redmond, 45 million. These are the values we're using, and this is the total remaining values associated with these properties. They are not developing new properties. These properties are not having children. This is a melting ice cube, and they are actively trying to get rid of the remaining properties. We see residential, a very small class, $20 million, multi-tenant retail, 205 million. There's 180 million of non-core properties. You can see there's 22 properties remaining in that category. And then we have 290 million in our consolidated. This is providing a lot of transparency into what we're looking at. And if people have any questions or thoughts about these property values, I really encourage you to reach out. Eventually, this will be up on YouTube. You can leave your comments below, and we will look at them, and we will discuss them, and we will evaluate your thoughts very carefully. Let's look here for a moment at how we derive these, how we go about this analysis. There's actually just a few key factors, but each mall is extremely unique. So you have to go one by one to catch all of the outliers. There's only 45 left. It doesn't seem like that daunting of a task anymore. Here we can see Aventura, Florida. Okay, it's 65% leased today. We have rent ranges. We have net operating income ranges. We know the cap rate from the CBRE data, and there's an occupancy range. From there, we can get our low-end estimates, our high-end estimates, and we can develop our base case. In this case, we can see Aventura here is 215 million, but it can be noted we have a very wide range. And in fact, when we presented this to John this week, he remarked that they have similar ranges internally. The market is really uncertain right now. There has been a lot of the demand for this type of commercial real estate has dwindled significantly. Banks are really reluctant to lend at these levels. Earlier this year, there was basically a run on deposits, nearly a run on deposits at local regional banks in the US. And banks are just much less willing to lend. So here's what we're looking at in terms of Aventura. If we look at UTC, a property in San Diego, 100% is leased. We have rent ranges, we have our NOI ranges, and we have the cap rate. The cap rate, 5.5% or maybe 6%. And the occupancy rate is 100. So here we again have a low end price. We think that UTC San Diego would go for nearly 100 million. We have our base case, which feeds into our analysis at 112. And then we have the high case around 140 million. And this is the process that we've gone through with every single property that we're evaluating. In fact, throughout the team, we have reached out to dozens and dozens of different brokers regarding each property to get further conviction around our assessment. Finally, we can put this all together. And I think it's worth showing this today. We have 5 very simple categories: the premier, the residential, multi-tenant retail, non-core, and unconsolidated. When we look at all of those and add them up, we simply see we have 1.1 billion in assets. There are not any additional assets coming into this firm. They have some cash, 120 million. And that's the total amount of assets we see. They have debt. They have debt to Berkshire that they're paying off. They have 480 remaining in debt to Berkshire. They have another 70 remaining in some preferred shares. And we estimate that the total cost of their remaining cash burn really through 2024 and into 2025 is going to be about $100 million. So it's going to be basically impossible for them to liquidate without paying out $650 million, maybe more, to get to this approach. So if you have 115 remaining, once the liquidation is complete, and there are 56 million diluted shares outstanding, the strategic alternative intention is for them to distribute dividends at that point. And by our calculations, there's only $9.20 per share in value today. That is based on our base case scenario. There's a lot of downward pressure on that base case, and that is a snapshot of today. Further, there are considerable delays taking place, delays in sales, delays in gaining entitlements, delays across the board. There's a number of issues. And each time that we review all of these properties, it should be noticed we are giving you our snapshot today, but we understand how trends work. And this snapshot has been trending down quarter after quarter after quarter. We don't expect that there's capacity to pay any dividends in 2024. We think dividends will begin in 2025, and that's going to shock shareholders because management has not provided this information. The last management update with details is that they expect to distribute $18 to $28 per share. That is completely wrong. It's false. They just haven't put out a new clear statement. They simply say, we don't know. And so a lot of shareholders are resorting back to the original statement, but that is not what's going to take place here. And it's not going to happen next year. So if we receive $9.20, the full amount that's coming in 2025 or 2026, we need to discount that back to 2023. So what is the reasonable price today? The share price today, I think, is around $8 a share. But who would pay $8 for potentially $9 in 3 years? We don't believe this is the right price. Perhaps it should be $6, but this is not a compounder. This is a melting ice cube, and it's for people who are looking to capture some of these potential dividends. We think the downward pressure is significant. We are not passive with our infinite compounders. We watch them very carefully. And when interest rates were climbing and banks were not lending, we quickly reversed this decision. It was very wise. We exited for a price roughly around 11, and we purchased for under 6. So we managed to achieve 100% gain in about 2 years. It's phenomenal. So with that, we're going to jump into a very exciting point of this presentation. We're going to go through the structured dividend capture. This is, again, where this is alternative to our cash holding. In value funds, we are notorious for being patient and holding on to a lot of cash. Warren Buffett's sitting on $142 billion to put to work at an opportune time. The challenge with holding all this cash, especially in previous really low interest rate environment, is it's sitting around earning nothing. There is a very large opportunity cost. And we are constantly considering how we can increase the yield on our cash. And what we have found is remarkable. There is nobody else doing this. We came up with this thesis. We've tested it. We've back tested it. We've had technology teams implementing things. And I'm going to show you great detail right now. Here's an upcoming example of how we're going to capitalize on the future dividend coming from eBay. We will be putting this into work. Next week, we need to have a put. We need to write a put that's expiring on eBay with a strike of 43, and we're asking for about 6 cents on that put. The return that we receive from that put is about 1.4%. Okay, 0.6 on our 4240 in collateral. Immediately after that put expires, 1 week later, that binomial outcome occurs. We either buy the stock or we don't. If we don't, we catch a 1.4% gain. We move on to a new opportunity. And if we do, we are immediately rewarded with a 25% dividend, 25-cent dividend. And then we turn around and we write a call and we exit. We can right now receive about $1 for our call. So what does this mean? This means over the course of 14 days, in 2 weeks, we pick up 0.6 cents for the put, we pick up 0.25 cents for the dividend, and receive $1 for the call. And if we're able to enter for a price for a strike of 43 and exit for a strike of 43, we achieve a 4.4% return in 2 weeks, and we are back to cash. It's truly remarkable. Here's another example. Oracle, coming up just in a few months. We'll look to sell a put that expires on October 6th. We'll try to write this for about $115. Given today's prices, this is what we anticipate. And perhaps we can pick up a strike premium of $2. So that will deliver us a 1.8% return, even if we don't buy the shares. And if we do buy the shares, we'll be immediately rewarded with this 40% dividend, and then we'll sell the call, and we will exit after receiving that $2 call premium. So again, after 14 days, we'll pick up $2 to enter, 40 cents while we hold, and $2 to exit. It's a 3.9% return over a 2-week period, and we will immediately be back to cash. The annualized return on these is astonishing. 169.5% return in doing this with Oracle. But the problem is you can only do this 4 times a year for a given stock because they only pay dividends 4 times a year. So we've gone through enormous analysis to find high quality businesses. They don't need to be the best businesses in the world. They need to be relatively stable. They need to survive and be around and not move significantly during a small holding period, 2 weeks. That's all we need. But the analysis is enormous to find these. It's not even possible with manual processes. So what we needed was to develop a technical solution. And that's exactly what we did. We've been working on this for several years. We hire interns that help out with Python. We've been working with Sid Christian and USC and some of his students to get this in order. We begin now with the same process. We do our automated 13F analysis to come up with a superset of data. We then overlay it with a whole lot of financial data, trying to identify red flags within the system. Situations where companies may have too much debt, or there's poor earnings quality, something that would alert us to the fact that these shares may not sit at this price. And then finally, we go and we download a lot of market data to understand which of these positions have dividends, when those ex-dividend dates occur, which of these opportunities have options, what the expected IRR would be, and we identify a Gantt chart as shown here as an example. That is our capital flow for our cash, going one after the next, putting our cash into companies that are about to pay an extremely profitable, lucrative dividend. And here is what we have. This is a simplified, forward-looking example. This is extremely valuable information. What we show here in the graph and in the chart is that if you start by selling puts on eBay, and as you exit, you go to Southwest, and then HP, Broadcom, US Bank, Bristol Myers, and if you conclude with Oracle, over a 3-month period, if this all works perfectly, it will result in a 41% gain over 3 months. The annualized return there is 300%. Obviously, we don't expect all of these to work, and this is a simplified version because this is a single capital flow where we're using a basket. So instead of just having eBay, we will have a basket of 4 or 5 firms that we're looking at every single weekend and writing new contracts for the upcoming expiration date. But the annualized returns here have truly been extraordinary, and it lowers our opportunity cost to hold cash. It allows us to be more patient before we can deploy the capital into its ideal place, which is sitting in its infinite compounder. So, over the last several months, we have been fine-tuning data. We have been doing a true backtest over the last data over the last decade. Here we show an example from 2014 through 2020, where we have analyzed exactly what we would have done at that moment in time. What we have determined is that the performance on this strategy will yield 18% annualized, and it grew $1 million to $3.7 million over the 7-year period. It's very remarkable. We don't expect it to be consistent every year, every quarter, but this is an extremely attractive rate of return on essentially a liquid cash holding.
Regarding this dividend capture process, you have to factor in a drop in the share price after the ex-dividend date. How does that get factored into things?
In our models, we use an equity adjustment factor. Actually, you can see it here in the chart. That occurs if we're selling our puts and call strikes at different prices. So that's how we practically account for that. I think a common consideration is that, given efficient market hypothesis, people assume that when you pay a dividend, the shares drop by exactly that amount. I mean, that's what hypothetically should exist and should occur in theory. But in practice, it doesn't work that way. I mean, the share prices don't drop by precisely what the dividend is. A lot of times the price can stay or climb. There can be other factors. So we've found quite regularly that we don't see, a 25-cent dividend and then the prices all start declining. We're able to capture these strikes that we're presenting here. And if not, Brandon, the objective, this is also a common question. What happens if you sell a call and then you don't exit? Well, we just keep trying to, we'll sell a call the next week, but we just keep trying to exit. Our objective is to quickly exit the existing position and move to the next one. It can be noted, if we're earning 4% on eBay, if eBay were to fall 10%, which would be a huge anomaly during our 14-day holding period, we would actually only lose 6%, and then we'd pick up another 4% the next week. So not every one of these works. We do experience some drops, and in our basket, we might have out of 5, maybe 1 will decline. But on average, what we've seen is that the results are backtesting results, which they go for too short of time. There can be common criticism that I'm aware of. 7 years of analysis is wholly insufficient, although finding accurate data going back further is a very, very difficult challenge for us. But we have shown an 18% annualized gain for a series of years. And this strongly outperforms the S&P 500. In fact, it would be quite volatile at times, but this strategy alone, I think, would allow you to outperform the S&P 500 and would put you in a totally separate category from 95% of the world, because it is extremely challenging to beat the S&P 500. And finally, our team is growing, and it's very impressive. We have Andrew with us. Everybody's with us here today. Andrew is extremely instrumental in the analysis and operations of our firm. It's been a real pleasure to work with Balram this summer. Balram's been our intern here. He's getting his MBA at Columbia University. Nadeev has been a huge asset. He joins us from UCLA. Sid, we couldn't be doing all this without him. Sid is a professor at UNC, and he has been providing us with resources like Aiden, who are truly experts in Python and able to help us develop our code efficiently. Finally, at the bottom, I do show Masood. Masood's running the portfolio for our Talus fund, but we are working together very closely, and it's a benefit to have Masood involved. It's a benefit for Peterson Capital Management to have Masood involved. And finally, I want to extend a nice thank you to all of our treasured service providers. These folks really keep the business running smoothly, from Eulich and Associates, Josh. Many of you know Josh or receive your statements from Josh, from our Spicer Jeffries, our auditor, who is providing K1s for the group, providing audits for our annual reports for all the LPs. This is a robust set of service providers, and we really appreciate everything that they bring to the table.